Hello and welcome to the long and short of it. I'm Patrick Ceresna.
And I'm Nick Galarnik.
All right, Nick, let's get into it, buddy. So last week we talked about repair strategies and ways to fix things. It was a nice market bounce in many of the examples that we gave. At least the ones that I was using with a lot of members, all of them gave some reasonable bounce where a lot of the repair strategies worked. But you know what? The market still seemed to be in a bigger distribution cycle and some sort of heavier selling. And so it's your turn, buddy. What do you want to talk about this week?
Well, I mean, broad market wise, I think that it seemed like we're going to have a nice bounce in the April OPEX. And then last week, as the market's been doing, they've been hanging on to Trump's every word. And he announced the new auto tariffs that caused some excessive selling in broad markets and pulled down a lot of names we were discussing. So today I want to talk about leaps because I think that with this market sell-off, it's providing for very, very good long-term opportunities for those investors that want to buy names that are, in my opinion, undervalued, but also fundamentally strong in a business sense overall. Like as Benjamin Graham calls it, the margin of safety, where the lower you pay or the lower price you pay for an asset, the higher the probability you have of making money and not losing money.
I was going to just mention that, it's an important debate to have, because when someone thinks long term, if I'm buying a cheap asset and I know it's a good price, why don't I just buy the stock? Like why is it that I would turn around and rather buy a long dated option versus that? And I think it's really important that we address this because there's pluses and minuses to doing it both ways. So let's dive deeper into this. So in your mind, what is the advantages of using long dated options versus that of using a stock?
So when I look at the two different scenarios, like let's say, for example, you want to buy a stock. Well, like let's use Google as an example because I've been watching Google for the past few weeks. I mentioned a few weeks ago that I thought the stock would bounce above 180 to like around 190-ish. That didn't happen, obviously. I was wrong. But that being said, the stock has sold off more down to a low of 152-ish yesterday. Now it's at almost 160 again. So when I look at a name like Google, for example, I see a name that's ubiquitous in our lives. We use it every day. They're a leader in AI. They're a leader in quantum computing. And they just acquired Wiz, which is a cloud cybersecurity company. That's going to integrate very, very well with their service offering. So long term, I think they're investing well for their overall broad portfolio to offer excessive value to both their customers and investors as well. And when I think about what happened last time back in September-ish when they sold off heavily, actually no, this was back in I think October, November, when the FTC announced that they were going to look into Google and maybe perhaps force them to sell Google Chrome, the stock price sold off about 20 points in a few days. But what happened? It recovered very, very fast because, as I mentioned previously, the only companies that could afford to purchase Chrome would be the ones that are not allowed to buy it, like a Microsoft, an Apple, for example, an Amazon, right? The same problems would arise in antitrust that the FTC doesn't want. And so therefore, I don't think that they'll ever have to sell Chrome. That being said, they may end up divesting of certain assets or splitting them off, kind of like Amazon did with small portions of the business. And Amazon may do eventually where they break up and they say, you know what, we're going to spin off AWS as its own business overall. That would unlock a lot of value for shareholders in Amazon. But regardless, I'm speculating here as to what may happen, which is not, a good way to invest. But I do like the valuation of Google right now and the overall setup based on where it's at. So, as an example, I'm just using this as a very primary example here of buying stock versus buying.
Well, before we get on that, let's just though I want to highlight, just build on the conversation of where Google is in the cycle, and then we'll get into the comparison in a second.
Yes.
Sure. Now, their fundamental analysis could be very well spot on, but there's the macro pushback to that story is that the Mag 7s as an aggregate uh, were a global leader, where basically the seven stocks became such huge market cap behemoths, not only in the US, but even on a global scale, that they absorbed almost all of the excess capital of the markets. We're now
Mhm.
clearly seeing, driven in many ways by the administration that's in control in the United States, that the appeal of investing in the U.S. has diminished. The risks have increased, and a
Mhm.
lot of investors are redistributing capital globally, repatriating it from the U.S. and moving it
Mhm.
abroad. And generally, this type of liquidation has nothing to do with the fundamentals of Google, right? Like, this is a
Correct.
bigger macro event that is driving that, and ultimately, when that cycle finishes, you're going to be left with a stock that is like you're saying, at a good valuation. The trick
Mhm.
is kind of, when is the fulcrum point of where that macro selling has played out and the
Yeah.
fundamental story is actually kicking in, that you're getting this really cheap stock. And so we have to accept that there are risks to Google, one from the things I was highlighting versus the
Mhm.
opportunity that you're highlighting. And when you have that, then comes the debate of, therefore, should you own the stock versus should you own a long dated option. And so
Mhm.
this is a kind of good way to segue this into this in this conversation, because clearly, no matter how cheap Google is, there is going to be a certain degree of volatility associated with the stock.
Yes.
And if you own the stock without it, you may experience short-term pain for that long-term gain. And so let's talk about it. So why, in your mind, do investors choose to trade these long-dated leaps versus stocks?
Well, the primary reason is one, leverage, and two, reduction of risk overall. So, as an example, with Google, right now it's trading at spot price 159.34 roughly. Let's round it to 160 for argument's sake. So, 100 shares will cost you about $16,000 US. Right now, if you want to go out as far as possible on the option chain, expiration date wise, you can buy a December 17th, 2027 contract. That's 990 days away. So almost 1,000 days from today. And you can buy, for example, a slightly in the money contract, which emulates ownership of 100 shares. Let's use, for example, the 150 strike for argument's sake.
Mm.
So the current spot price of one of these contracts is around $43 at the midpoint. So when you combine the strike price of 150 plus the price of the contract at around $43, your break even there is 193, which is about $33 above the current price. You might say, well, Nick, like, why would I spend, more money than the stock is trading at right now, for example, right? Like, why would I pay a higher price? And the reason being is that, if Google pushes back up to, let's say, for example, 200, 210, 220, perhaps, this contract will increase in value percentage wise at a greater rate than the stock price will. Now that's one benefit. Now the counter benefit is that, let's say for example that I'm incorrect in my thesis and the stock price falls to, let's say, 130 or 120 and the market sells off further, which is a possibility. I mean, all that's going on right now with these tariffs and trade wars, it's somewhat reminiscent of what happened during the Great Depression. Not exactly, obviously, like back then, a very different situation. But the idea that the U.S. is implementing tariffs on every single importer trying to export to the United States is similar to the Smoot-Hawley Act, I believe it was called, back in the 1930s. And what that would do is it would cause inflation to skyrocket in the United States. Plus, it would cause like a decline in economic activity. So it would cause stagflation, which is not good at all. And everyone globally would feel the pinch. And as a result, the stock price of Google would probably go down as well because they're heavily weighted on advertising. So they wouldn't be immune at all whatsoever. So I'm throwing out the worst case scenario where Google goes to like 120, 110 a share perhaps. In that case, let's say, for example, we're looking at today, what would happen to that contract? If Google were to drop, let's say, for example, $40 from the current price, this same contract I just proposed, the $43 contract at the 150 strike for 2.5 years out, almost 3 years out to just December 2027, that contract would go from $43 right now to approximately $28. So while the stock price falls $40, the option price falls only about
Yeah.
$15. So that's a huge benefit there, because when you think about it, if it were to fall to, let's say, 110, 120, now you can analyze and say, okay, do I want to still own Google at this price? Do I think it has potential to hit that 190 break-even price by December 17th, 2027? If you do, you have a lot of ammunition now to re-up and add to your position, right? Because if you were to buying 100 shares of stock at 16K a pop, that's basically almost 4x the investment required right now to buy one of the 150 strike call options for that expiration of 2027
Yeah.
December. So basically, if you bought one contract right now and then it fell, $40, you could buy a second contract for, let's say, like $28. Now all of a sudden you have 28 and 43 is what, is that 71 divided by 2? You have like a $30 ish cost basis. Is that right? Yes, I think that's correct. 71 roughly. So it would be a $36 cost basis roughly. So your break even would then be 150 plus 36, which is 186. Not a huge reduction overall in premium in your break even price, but now you have two contracts to trade with. If it goes back up again, prematurely, let's say it's back to like 190, $200 by July, August, September this
Yeah.
year, which is a possibility as well. At that point, you can say, you know what, I'm going to sell one contract, take profit on that, and then ride the remaining contract, for example, right? And this can be
So
extrapolated to 10 contracts, 100 contracts, whatever your overall portfolio percentage risk allocation would be on a given position, that would apply here overall, right?
So I want to talk about convexity, but then afterwards, I want to touch on the fact that you chose to go something almost 3 years out in length versus, let's say, doing only 1 year out. Like we'll talk about the different behavior of options and that to play out. But the one thing to just build on what you were trying to convey, I like to describe it this way, which is you are paying for first of all, I want to highlight that you don't want to look at break even and cost of a leap in
Of course, yeah,
at end,
yeah,
because so when you talked about a break even at 193, the reality is you are likely not going to hold this leap until its expiration. So you're
correct.
never going to experience $40 of time decay. And more importantly, even a year from now, there's probably going to be $28 to $30 of time value on
Mm,
this option for a 1 year carry, even if the stock did nothing. And so
correct.
you have a lot of time for you to discover whether the thesis and the trade that you're looking for is actually materializing without thinking
Mm,
about this cost of this option as this absolute loss. Because when you do a 1 month or a 1 week option, it always has to be a consideration that could get zeroed, right? Like that
yeah,
option has you have to consider that the downside risk is that that option is worthless. With
correct.
leaps, you don't have this thing. Even if Google dropped $30, that
Mm,
leap is maybe shaved off $10, even
yeah,
even if that much. But I want to talk specifically about the convexity, and the convexity I like to describe this way: what you're buying is a leap that basically the more wrong you are, the lower the delta gets. So the rate of your loss keeps slowing. The more and more wrong you
yeah,
get, the rate of loss is flattening. And so
yeah,
you have literally bought a contract that is, if I'm terribly wrong, and it's going really badly, my losses are actually not delta one, where like a stock, every dollar goes down, I lose a
Yeah, yeah.
dollar, but your losses actually slow the worse it
Decelerating.
gets,
Yeah, yeah.
decelerating. And at the same time, in the same principle that convexity, the more right you are, the more the option behaves like the stock. As it approaches a
Accelerates. Yeah,
delta,
yeah,
accelerates. And so you
yeah.
are paying this premium for the convexity, that
Hmm.
you're so that you get that acceleration and deceleration on either end
Hmm.
versus the 45-degree angle that comes with a traditional stock. And so,
Correct.
this I think is important to highlight, because too many traders look at it as my return at end, right? Which is, what is the
Hmm.
payoff profile in the hockey stick curve of the
Yeah,
call option at its
as if we're
expiration.
a European option, right? Yeah,
Yeah, and
yeah.
yet you're not going to experience that, because the odds are you're not going to have that full holding period. So
Correct.
now I want to talk about this, because we can pull up here. I'm going to pull up an options chain on it, because I want to talk about it. I'm going to use Google with the L's. So we're trading at 157 versus the GOOG, which is a 159, right?
Hmm.
But so you were looking at, let's just stick with the closest at the money, so like 160 strike. We can see that we're talking like a $39 option. Let's just round it
Yeah,
for
yeah.
right now, buying this 990, almost 1,000 days
Hmm.
of option. Now, if we go and look at a January 2027, shave almost a year off. All right, let's go December of 2026.
Yeah,
And now
shave a
we're
year
going
off.
to
Yeah,
go exactly a year off. Notice that this option is basically $29, $30. So
yeah.
you're talking about for one additional year, only 10 additional dollars in cost. And if Google stayed the same in terms of implied volatilities and price level, then you would have only had a $10 carry cost in owning this
Hmm.
option for 1 year, right?
Correct.
And that, so you want to also take into account roughly the rate of which one of these long dated options time decays.
Hmm.
So now the debate though is that should one just go 1 year? So now that we know it's roughly $30 to buy this December 2026, right now, January 2026, 290 days, it was a leap. It's slowly not becoming a leap, because it's coming within 9 months of its expiration. But
Yeah,
a 160 call here is $19. It's
yeah.
still like
A
literally
lot
to
of premium.
buy 290 days
Yeah,
costs it to get 3 years versus 9 months
yeah.
is just double the cost.
Yep.
And
Nope.
if everything stays the same, you can carry that long dated leap for 2 years and still recover 50% of its value if the stock is unchanged and trading at the same volatility premium. And so
Yeah.
you have a lot of forgiveness with those really long dated options. So what are some of the disadvantages? To me, one disadvantage is longer dated options tend to have wider spreads and less liquidity. And
Of
so
course. Yes.
you're going to have a market maker tax getting in and out. So you can't really be short-term tactical, buying and selling too often. You have to
Hmm.
position yourself into this leap and accept that you should make as minimal transactions on it as possible to your exit, because the more
Yeah.
frequency that you make these trades, the more you're going to be fighting these wider spreads, right? And
Hmm.
so this is the trade-off of that longer dated option. And at the same time, you're also going to generally have less gamma. A $30 move in Google on that long dated leap is going to have a much slower delta increase.
Hmm.
than the shorter dated one. So there's all these trade-offs, but in some degree or another, with it having less gamma and therefore more a stable delta, you
Hmm.
can literally treat the long dated leap almost like an equity. Because if the delta is
Yeah.
going to pivot very close to 40 to 60 cents throughout the volatility of the ups and downs, then you can pretty much buy the exact amount of delta you wanted to have on the upside.
Hmm.
You can say like, if Google goes back to 200, I want to make 20 grand. You can pretty
Yeah.
much backwards math a very simple amount of how many options it's going to take me to have that kind of a profit
Yeah.
if that stock moves, right?
Yeah, absolutely. Yeah. And I mean, one benefit also as well, if you're trading in a margin account and not in a cash account, is the ability to do like the poor man's covered call where you sell shorter dated options against your long dated options. So again, this is where I go back to that whole break even price, which again, as you mentioned, should not really be a consideration for most investors because most people won't hold this contract expiration. I mean, it's rare that it happens. Um, for me, in my experience, the only times I really hold contracts to expiration are if I'm selling a cash secured put, for example, and I let it get assigned. Like on Palantir, I sold some $10 strike puts when it was like I think $12 a share about a year out, and they were like $1.80, $2 each. They got assigned, and I was happy because after assignment, they ended up pushing back to like $14, $15, and now they're at 80 some odd dollars a share.
Right.
Um, but with Google, let's say again you go back and you buy that December 17th, 2027 150 strike call option for, let's say you pay whatever $44 right now. So your break even is 194. Well, if you do that and let's say it pushes back up to 180 in like 2 months time, you could probably sell the 210s, 220s, a month out, 2 months out, and you're probably pulling in $1, $2 every month or so. And when you think about that from a cash flow standpoint, if you're pulling in, let's say, a dollar on a given month against an asset that costs you, let's say, for argument's sake, $40, right? That's basically pulling in 2.5% return monthly in cash flow. And you're
Mhm.
reducing your cost basis by that much as well, while you're still maintaining upside. Because if it pushes, for example, that 210, 220 area, you're well above your break even on the contract. So you're making, for example, $20 profit, $30 profit on the contract itself. Plus you're making that additional, $1, $2 premium. Again, it's small change, but it's a way of kind of mitigating your time decay in a small way and kind of
Yeah.
charging rent to yourself. It's almost as if you own a house and you're essentially taking your business and maybe you're renting it from yourself, and it's benefiting you in some way, right? If the property value comes down in the short term, you don't really care so much. In the long term, you want it to go up, right? So
Right.
these PMCCs, per month covered calls, the acronym is PMCC, they can be very beneficial too because you can ride these waves of market ups and downs, and you can hold your position while also reducing your cost basis. So like just as a small example, right? Let's say you said, what, I don't think Google's going to recover until next year, for example. So let's go to January 2026. Well, right now I could sell, for example, the 210 strike contract for $4, right? If my break even is like, 193, for example, then at 210, I'm making a profit of $17 on 43 risk. That's almost a 44% return roughly, something like that. But if I'm pulling in
Mhm.
$4 premium as well on that 210 strike, and let's say by year end we're trading at like 200, so this contract expires worthless. Now my cost basis is down to like 40 because I subtract that premium I pulled in of 430 whatever. And now my break even is 190, and I can sell, for example, a month out at 220 or a month out at 215 or 210 again if I wanted to, and keep on cash flowing my position. If it takes off and goes to 220, for example, then maybe I'm going to say, what, I'll get assigned that short contract, that short call option, in which case I'll be short 100 shares in my account for a short duration of time, and maybe I'll play with that position. I'll let it get assigned because I own the call option. There's no risk to me of it moving up and going
Right.
parabolic. If it pulls back down
Right.
again, I can then buy back that short position at a profit when it's opportunistic, and keep my long term position, my leaps, um, as my core holding, right?
Right.
And I think back to like my play on ExxonMobil during COVID, where I bought like right at the peak, right before we sold off heavily, and those contracts I got for like whatever $12 it was per share or per contract, down to like $1 per contract, and I was able to average down. But I bought so much time. I bought 2 years out on those contracts. They had time to marinate and recover, right? With Google, going out a year, maybe we get a terrible market. Maybe we get like a 2022 this year where we just sell off all year long and go down to, let's say on SPX we're down at like,
Yeah.
4,000 again, which from the current level is about 1,500 points or so down from the current level, right?
Right.
That's a pretty big sell off for a name like Google, which has a decent beta against the market. It'll probably sell off
Yeah.
roughly, let's call it a 30% haircut from here, right? So you're down like what, like 45 some odd dollars roughly.
Yeah.
You're down at like 115. In that case, even if you're holding that 2 year out 150 strike call option, like I said, you can average down. You can be patient because again, you have so much time. It may dip down to 115 and then go to 220 within a couple of years, for example, right? So like
So
having that time is important. And yeah, go ahead.
yeah, no, it's I completely agree. The one thing I wanted, because we have only a few minutes left, and what I wanted to
Yeah,
just have the debate, because it's a really interesting thing for a trader to think about. So let's use your Exxon example. Okay, so Exxon, let's say, traded from your $12 leap down to $1, right?
yeah,
Let's go on a weekly. It was during COVID, right? So let me
during
just see
COVID, yeah.
what let's see what Exxon did
I
here
bought
during
right
that time.
before it sold off, like right before. I bought in the money $60 strike call
Yeah,
options right before the market sold off.
yeah.
So
So basically, the thing goes from $80 down to like 30. All right. So
that's
now,
right. Yeah, yeah,
those options that you bought were basically now trading $1. Now the question is this: there's two choices, and they're not really right or wrong. But the debate
mhm,
is what you did, which is, well, shit, I can dollar cost average and buy two or three
yeah,
times as
yeah,
many options at $1 and bet on an Exxon recovery. And if it comes back, I've improved my average cost base considerably and can turn
yeah,
this into a big profit. The alternative, though, is, well, look, Exxon just lost $50 and you
mhm,
lost only 10.
yes,
And you have a scenario where the investor did exponentially worse than you. But
mhm,
the alternative is, do you roll down your strike? Do you go from the $80 strike to, let's say, when it's down to $30, and you roll down to the $50 strike, which might be $4 instead of $1?
yeah,
But you now, instead of having a strike where your intrinsic value only kicks in when you're getting above 80, by putting more capital in by rolling down the strike, now you only need the stock to go up $20 from 30 back to 50. And
yeah,
now you're building intrinsic value much sooner. And so and in some degree or another, I think the answer to that is how much of a upside kicker you want above the strike. Like if you are super bullish and you say Exxon's going to $120 and this
mhm,
$30 price is stupid, and so $1 options could be worth 30, $40 each. Of course,
yeah,
just buying a shitload more of them makes a whole lot of sense, right?
absolutely, yeah,
But at the same time, if you're just saying, well, shit, even if Exxon just recovers half of the losses it made, I can be out of this trade at a profit. Like repairing it and rolling down the strike just gives you an easier way of also alternatively managing. And so I just wanted to have that quick
yeah,
conversation as to
yeah.
debating which way to go.
Well, I think it's actually a great idea to first and foremost like determine your maximum risk allocation in one asset, and then when I say that, I mean like for myself, for example, I'll only risk 5% on my portfolio in a given position using options, and that's across all expiration dates, whether it be leaps, short term,
Yeah.
whatever. But with stock, it's different because stock doesn't expire. So I'll be willing to ramp up my risk tolerance to 20% of my portfolio in a stock, for example. But back to your question, a good way to kind of moderate how you're going to choose your strikes and like, what combination, back to the Exxon example, for example, I could have bought, yes, at the money contracts for like $5-6. It recovers. I make, 300-400% return, but I'm risking $6, for example, right? Or I could buy those out of the monies, which I already bought. I paid previously for $12 per contract. Now I'm paying $1 per contract, right? Or less than $1 per contract.
Mm-hmm.
I could buy a lot more of them, and if it recovers, I make a lot more percentage wise. But the probability of that payoff is not as high. So this is where I think a combination thereof, especially when you're buying long-term options, makes a lot of sense. So even in the case of Google, for example, maybe you say, you know what, I'll buy a few 200 strike call options. I'll buy a few 160s. I'll buy a few 150s, for example, right? Then when it recovers, you say, okay, now I have a lot more risk in the 150s, for example. I'm going to take those off the table, take my profit there. That profit then covers the cost of the out of the money contracts you're still holding. Now, if it pulls back down again, you validated your decision because now you've locked in your profit on your leaps, which have a lot more risk on the table, even though you may be losing money on your out of the money contracts, for example, right? But if it keeps on pushing to the upside, you have all these out of the money contracts, which are now going, close to the money or in the money, for example. Delta's increasing, they're accelerating in value. And at that point, you're making a much more wise decision because you're not being emotional about saying, you know what, I have too much money tied up in this position and I'm worried about it. Like back to that Palantir example, for example, right? Like I own a ton of stock. I own some leaps as well. And when it started popping, back from $6 to $14, $15, $20 a share, I started de-risking. But what I did was I said, you know what, I'm going to take off my options first because my stock is so cheap right now. Like, want to hang on to it, right? As it popped up higher and higher, I would take off incrementally small positions to lock in some profit and say, you know what, I'm not being emotional here. I'm just being wise because as your position balloons in value, you can't have it comprise like half your portfolio. That's too much risk, right? All it takes is one small random news event to cause it to sell off 30-40% in a few days. And then you're battering your portfolio, right? And again, remember, part of the name of the game, and this is kind of like my final point for today and for our listeners too, is that when you're investing, part of your objective is to sleep well at night as well, right? Like good night's sleep is very important. Your health is important. So if you're not sleeping well at night by having these huge positions on with lots of risk, and I know a lot of people that do this, where they don't sleep at all, they check their phone at 4:30 in the morning as the market opens, checking futures all the time, that's too much risk. You want to have a level of risk sufficient where if the reward is good, you're happy, but if the loss occurs, you're not unhappy, so to speak, but you're also sleeping well at night as well.
All right. Love it, Nick. It was a great conversation, buddy. Listen, where can listeners find you?
My website, optionfinity.com. There's actually an email functionality on the site. You can fill out like a form and if you want to email me or whatever on the site. And I read all the emails too. So I didn't know this, but my web developer told me about it. So if you want to go on the website, you can like send a message or a DM, whatever, and I'll respond to you as well. So yeah.
Oh, really? That's fantastic. No. Anyway, and you can find me at bigpicturetrading.com. All right. Thanks, everyone. We'll catch you in a couple weeks. Cheers.
Thanks, guys.